right, we're back. Episode 4 of the Mortgage Show, February edition. Beds, how you doing?
Guess who's back? Back
Number
again.
4, dude. I think the podcast has been well received by people that we've been sharing it with, which is nice. Getting some good info out there, some good feedback. How's that been for you?
It's been good in that same area, but also it's good to have a back and forth with you because it keeps us fresh, talking about this stuff. So I like it.
Yeah, it's been fun. All right, so normal format. We're going to go through some market update stuff, share a product idea, some underwriting stuff, tips for realtors. Then we'll bring on our friend Jeff Lee from Farmers Insurance to talk about the changing insurance landscape, some of the stuff that we dealt with from the floods a few weeks back. So why don't we get started with an interest rate update? How was that, Beds? Any good news earlier this week? Or
It's been a little bit lately of some better economic news than we expected. I don't know, man. The mortgage fund trading, even though it's green today, you can see the furthest most green candle. So we've had a little bit of a bounce back, but the last 1, 2, 3, 4, 5, 6, 7 days, mortgage-backed securities are not liking the fact that we had a better than expected jobs report, a little bit higher of a CPI number earlier this week. So it's like we've been chasing a little bit. So we've had some upward pressure on interest rates. One thing with just showing this chart here is there's a blue line that comes through, and that's the 200-day moving average. I want to mention this because when we are trading above the 200-day moving average, that's typically an indication of when interest rates are really starting to try to lower again. So we've been trading above that now for the last couple of months, which put downward pressure on rates. And, it's kind of been nice through December, January, but here we are, we're touching the 200-day moving average. So hopefully we sit here and bounce back up and we start seeing some rates lowering again. But I don't know, man. I'm hoping this is temporary.
Yeah, you can kind of see that it bounced off that 200-day moving average a little bit. So just to make sure everyone's on the same page with what happened on Tuesday, the CPI number came up and it rose by 0.3% over the last month, which is unexpected, and then a 3.1% rate over the past 12 months. I think the market was hoping for 2.9%. It'd be the first time since I think 2021 that CPI on an annual basis would have been below 3%. And that would have been a good thing for us. So the fact that it came in at 3.1 is not great news for the market. And like we were just showing you, the rates responded. So we're back up to this higher than what we were hoping for as of mid-February number when we did this a month ago. We were kind of hoping that rates would keep trending downwards, and it kind of went the other direction. So we'll see. There'll be more job reports. There'll be more inflation reports, and we'll see what happens after that. But that's where things are as of right now.
I think a really big thing to remember, guys, is that mortgage-backed securities absolutely hate higher inflation. We could deal with better than expected jobs report, manufacturing. You'll get a little dent in the trading for a few days, but when inflation is up, mortgage-backed securities hates it. So hopefully this is temporary.
Hopefully. We'll see. So that's the latest on that. Product update. So it's been an interesting market in terms of inventory over the past few years. More and more borrowers are not liking what they're seeing sitting on the market. So I know they come to me all the time with these type of questions, and I know they go to YouTube Beds, but they flirt with the idea of finding land and building a new home. And we do have a product for that can help them. Why don't you tell us a little bit about the single close new construction loan we can do as little as 5% down on?
See, that's a big reason why I get my foot in the door for some of my referral sources is the 5% down option, because typically your construction loan scenarios are 20 to 25% down. If you own the land already, usually you could use that equity stake towards the down payment in a construction loan. But let's say you don't have that equity and you don't have 25% down. So what are you going to do? We do have a 5% down construction loan scenario. So it's a standard conventional product. It's a Fannie Mae product. It goes off of desktop underwriting findings. So it's pretty casual where, we get an application from a borrower, we run it through desktop underwriting, and we get the findings right away, and we find out if a borrower qualifies. So a couple of random things on it. It's a 720 or higher mid FICO score. You do have to have the 5% down. It has to be your own funds. Here's the twist to it. So it's like, we're going to give you 5% down, but we want to see that you have 6 months in the bank as reserves somewhere. So it's interesting. It's kind of your push-pull with the product. It's like, if you do have the 6 months, wouldn't you liquidate it and put yourself in a better construction loan? But, the option is here for borrowers to use it. We have it. We underwrite it in-house post-closing with all the draws and all the inspections and stuff. We handle it here, so it's not like we're outsourcing it. So it's a product we like. It's a product we service.
So some of those things you mentioned are not typical of conventional loans, though. Just so people are clear on that, you can typically go lower than a 720 FICO score. On paper, go down to 640, but it gets a little bit harder to do that in certain situations. But so this is a higher minimum there. Having to have your own money is not normal for a regular conventional loan. You could have a gift completely from family, and then that reserves requirement is not typically a thing for other non-construction conventional loans. So it just shows that they do have some added requirements, but we can do it. For the right people, it's easy. It makes sense.
It's definitely like a niche type of scenario. It's gonna fit for only a couple of borrowers, a couple of certain borrowers, but we have it, and that's the great part about it. And the fact that we can get quick results on the desktop underwriting is also a benefit also. So
yeah. I think the hardest thing with those type of loans can be the builder contractor side of things. Those professionals tend to still be pretty busy right now, and working within the confines of some of these construction loans can be challenging for those people. So, but we can do it. We can do it. We can dominate it. So,
dominate is what we do.
Unless you have anything to add, Beds, I'm going to move on to underwriting tips.
No, I like that you touched upon. I said regular Fannie products, and I mentioned in the higher FICO score, we do go down to 620 for conventional financing. So it's not, our conventional stuff is just not a hard 720 stop. So if we're outside of construction, we're definitely, down to that area.
It makes sense to have higher credit requirements for someone that is doing a construction loan. There's just more moving parts to it. There's more risk from a lender point of view. If you can minimize that by having higher credit score requirements, I think it makes a ton of sense. So I can't imagine someone with a 640 credit score walking in the door and expecting to get a construction loan for 95% of the value of what they're looking to build. It's just the nature of it's going to require better qualified borrowers.
You just nailed it, man. It's there, but we're only taking the best case scenario. Everything is risk-based in our business. We have these loan level pricing adjustments that dictate interest rates we give to borrowers. So it's like, on the scale of risk, your 5% down construction loan is not the easiest to get. So you got to be somebody that deserves it.
Yep, totally. Okay, so I'm going to move on to some of those underwriting tips. I say underwriting tips, it's just more like, I guess, underwriting facts or things that are going on in the market that we want to make the people that listen to aware of this. So one of the things that I want to mention was the fact that this isn't a realtor type thing, but it's just something going on in our world that might be good to know. That if you're a non-occupying borrower, you cannot do a cash out refinance as of March 6th of this year. So basically, if you have like a daughter or son that owns a home and their mom or dad co-signed on the property, they're on the loan together, the mom or dad is a non-occupying co-borrower in that situation. Those people can no longer do a cash out refinance together. Not that it happens a lot, but it is no longer a thing. Fannie Freddie are requiring that they can only do cash out refinances for people that actually occupy the properties at this point. It's a little bit of a change.
A little bit of a change, but also it tells you that the market recognizes some people are leveraging credit card debt. Cash out refinances typically are designed for consolidation if people are not doing it to improve their property. And I think this rule is like, when stuff like this comes across the desk, I'm like, okay, the smarter people in the room are recognizing the fact that people are over leveraged right now, and they're trying to not make it super convenient for borrowers to then stuff that debt into their home equity. So
and they don't want to stuff it into home equity on a home that they don't even occupy, because they have no problem. Not that they're going to leave the person they did co-sign with in a bad situation, maybe, but end of the day, if someone occupies a home or not occupies a home and they have mortgages on both, which one are you more likely to walk away from? It's going to be the one where you don't occupy the property. So they just don't want people taking cash out of properties anymore if they don't occupy the home, having co-signed with someone in the past.
It's funny, man. The guys that analyze risk are doing the things that the guys analyze risk on. Here we are.
Yeah. So just a little nugget to throw out there. Again, it doesn't affect realtors or the purchase market at all, but it is something that's out there. at this point. This
Well,
next
no.
one does affect the purchase market a little bit. We see this quite a bit. And this is the idea of closing with an offer letter. How often do you work with borrowers that are switching jobs? They're starting a job, but it's after we're looking to close. It
Pretty
happens, right?
regularly.
Happens a few times a year.
Pretty regularly. And I recently had to go down the rabbit hole between the two products, the government stuff and the conventional stuff, just because I have a borrower moving in from Vermont that's taking a position up at a college up north, and she's looking to buy something. I mean, she's got a great position that she's going to slide into. She's got a great offer letter. It's just a timing thing a lot of times. And it's like, typically you have to have 30 days of a pay stub to qualify for a mortgage, but job offer letter scenarios like this is, I got a loan in process because of it. So in this particular one, Randy, FHA.
Yep.
So job letters sometimes have conditions on them of employment from the person coming in. So in the case of this borrower, it's all a job letter. It's telling me what they're going to make. It's telling me when they're supposed to start. So me and the agent kind of timed that out with putting the property under contract. But one of the things that needed to be cleared up in underwriting as I'm still working through this loan is, did the borrower meet the conditions of the letter? So it's like, I want people to realize, okay, we got this product, but if the letter has 27 conditions to the employment, we need to make sure that those conditions are met. So it's
which is tricky because the conditions I have seen are like, you have to do ABC training when you start. And like you're not doing that training until you actually start. So in that case, like you would actually be expecting them to remove that requirement or get a letter that doesn't have another letter that doesn't have it or something. But yeah, when there's conditions, some of those conditions present challenges for us. Others are no big deal, but it is a thing. Just because you have an offer letter doesn't mean it's like fine.
Randy, it's interesting too, because it's like young Chris in the mortgage business on this particular question. So one of the ones that I got, one of the conditions that, like you're sort of alluding to, is like one of those was going away once she started. And I told her, hey, look, that can't be on the letter. So she comes back and she's like, the employer's not going to remove it. And 20 years in the business, Chris, who has dealt with like the feel part of questioning, just cut it to the Belichick area, Randy, and was just like, you're going to have to ask them to remove it or you can't get a loan. And guess what? She went to the employer and they removed that as a condition of her employment. So that was cool.
Yeah. But yeah, there's not a lot of gray area with that stuff. It's not like, oh, you don't want me to have that? Oh, okay, it's fine. Like it's like, no, it's like we need it because those are the requirements of the loan and the loan's not saleable if we don't do this. And, we can't do loans that aren't saleable. So it's just, it's that push and pull between trying to follow the Fannie Mae, Freddie Mac guidelines that we all operate with, but also like make it make sense for people that we're helping to get loans.
So we just mentioned FHA, so that's 60 days. Conventional is 90.
Yeah, it's good. Yep. So keep that in mind. A lot of times borrowers are relocating. Like you said, these people from Vermont are relocating. Like we deal with people that move from all parts of the country up to Maine and they're starting their new jobs and they're looking to get in their house before they actually start those new jobs. So definitely can be done. We just have to be mindful of the guidelines, which we are, but we will dominate those as well.
I love the word dominate.
I'll say it like 5 more times this pod. Okay, one last thing.
All right.
We are in the beginning part of tax season. Some people that we're dealing with have their 2023 tax returns filed at this point, and we want people to know that we can use income from 2023 tax returns to qualify at this point. These type of people that this even matters for are self-employed borrowers. People that have W-2 jobs, like get paid hourly, get paid salary, none of that stuff matters. Their tax return stuff don't really come into play. But people that have businesses, we can only determine an income based off of what they claim for their 2023 tax returns. So we can use that income if you filed. We just need to be able to show that at this point you have filed. And the way that we would do that is there's a form that's a 9325 that shows that you electronically filed with the IRS. If you have that, we're good. If you mail the copy in, you got to bring it to the IRS office, get it stamped, and then we're good. And then boom, we can use that income.
Can we mention how much you dominate knowing the 9325, no big deal?
I pulled up the right page off screen in that moment that I said it was pretty money.
Yeah.
But that's a big one. Yeah, it's a big one. So,
and can I piggyback it just real quick? Randy's mentioning stuff about proving income and filed income and stuff like that. And one of the things, and I want to draw back on it because I think it's a really good product, the DSCR loans, like non-QM loans that we have now, the 20% down borrowers, your self-employed people. we've got bank statement loans now. We've got loans now where if the property's making enough income to qualify, we've got some variances outside of what Randy just mentioned, but for your typical qualified borrowers, this is a good thing.
Yeah, this brings up a funny topic. I asked the borrower for CPA contact information so I could request a letter that the CPA would write for this person saying that they're self-employed. And the borrower said, "Hey, I don't have a CPA. Is there another way?" And my response was like, "There's always another way." Like that's our job. It's like we always have like the ideal way of doing things, but then there's always the other way of doing things. So yeah, if the tax return stuff doesn't work out, maybe the other way is different types of loan programs. If we have a requirement, and then you can't make it work, we'll find another way to make it work. I think we're both pretty good at that sort of stuff.
And I think that's reps. That's a reps thing. We've done a lot of loans now. We've been, burnt before, and we know how to pivot. We've done them all. So
yeah. It's definitely a reps thing. You can't read about it in books or when you're getting your licensing. It's just doing loans, and things getting a little sideways and figuring it out.
If we have a second here, Randy, I want to ask you, I know that with me, I am so afraid of failing and messing up a loan that my obsessiveness when I have these files that come across where it's like, okay, that's a little atypical. I dive in. I want to make sure that I'm not 90% through a loan and all of a sudden get caught by something. Is that what you feel?
100%. Yeah. I mean, through the first part of my career, things would sneak up on you just because of the reps thing, the lack of reps, So, and I remember what those conversations were, a lot of tough conversations. And most of the time we find solutions, but I just remember tough conversations with borrowers, with realtors, both on the listing side, buying side, sometimes even the seller. And it's like that stuff was awful, So I want nothing to do with that. I don't want to disappoint people. I want to make sure things go as smoothly as possible. So if there's ever any uncertainty on something, some gray area, it's like, we're going to figure this out first. Because when someone makes an offer that has a Norcom mortgage pre-qualification or pre-approval letter, we want to make sure that that's a solid offer and that there isn't something that's going to sneak up on us. Are we perfect? Do things come up that we don't have any awareness of that derail things? Absolutely. That's just the nature of the business, but we try to minimize it as much as possible.
Yep. Agree.
So, okay. Tips for our realtor friends, things that we see on our end of things that we think would be helpful for them to know. Got a couple that I want to share, or at least one that I want to share, and it might evolve into something else. Do you mind if I fire away on that?
Yeah, let's do it.
So this is the classic tip that I could give a realtor, I feel like. And it probably goes without saying for people that have been in the business longer, but maybe some newer people that might listen to this. It's when it comes down to asking for seller paid closing costs, especially after the inspection contingency part of things. When someone's asking for $5,000 in seller paid closing costs or $10,000 in sellers paid closing costs, and there's actually a reason behind it, because the furnace is failing, because the roof needs to be done, because there's an actual issue, just leave that out of the addendum. So instead of saying buyer to receive $5,000 in seller paid closing costs because of XYZ, just stop it at buyer to receive $5,000 in seller paid closing costs, period. And that makes life so much more easy.
Yeah.
Do you encounter that?
Yep. It's funny because I would guess that if I was writing those amendments to the ICAs or addendums, I would be inclined to explain myself or over explain myself as I'm presenting that for signatures. Mm-hmm. It's legitimately worst case scenario for financing.
Yes. That's caught me before, early in my career. You don't even realize it's an issue, but it says, $10,000 in seller paid closing costs because of the failed septic system. And it's like, oh, I don't even see it. Or the listing agent sends it to the title company sends it in and it bypasses us completely. And next thing you know, underwriting's looking at an addendum that says there's a failed septic system. And they're like, what? Leave that out of the picture. You guys already have it figured out how you're going to take care of it. The big thing is that the seller is giving you money, and just keep it as simple as that.
The seller agrees to pay $10,000 towards buyer's closing costs. That's all you got to say.
End of story.
Nothing else.
And if you are unsure of how to write that, reach out to us. I mean, I'm happy to tell you over the phone or put it in an email or something. If there's still any uncertainty, reach out to us. I'm happy to really make sure that we hammer that home instead of, worst case scenario is that it gets through and it derails the transaction. But like if I see it afterwards and then I have to ask you a second time, it just kind of looks messy to go back for a new addendum like 2 seconds after doing the first one. So we can kind of save some of that wasted time.
It's kind of awesome too, because it's like if you're over analytical, like I tend to be, like you would want to explain it. Just give it a try. Just put that simple sentence, 10,000. Don't explain yourself. It's so liberating. Just do it.
It will feel so good. But I know the tendency to, you feel like you're protecting everyone by saying exactly what that money's for, but it's more of a problem than anything. So I think I'm going to end it with that. We had some other things that we talked about, but we'll save it for next time. I think that's a good tip for people to know, to reiterate for people that have been in the business for a while. And then for some of our newer agent friends that are just getting going, something to keep in mind.
I like it.
So we have a guest that we're going to bring in.
Let's go.
His name is Jeff Lee from Farmers Insurance. And he'll have some stuff to share about this crazy insurance market that we're in right now. We had some floods in the past few weeks. Premiums are going up. Things are getting wild. So Jeff's one of the best in the biz. So he'll have some good info to share. So we'll bring him on right now. Am I right?
Let's do it.
All right. We got Jeff from Farmers Insurance on the pod with us. Jeff, thanks for making it happen, man.
Of course. Glad to be here.
Been a wild few weeks for you with everything going on with the floods in southern Maine.
Great.
You've been in insurance for how long now?
14 years.
So what's the past few weeks been like for you out of all those 14 years?
Honestly, Randy, probably the worst of my career.
Yeah.
How long do we have? No, in 14 years, and 10 of which were in southern Maine, I had one flood claim. As of January, I've got 5 open ones, I think.
Yeah.
Which is a little scary for both the bigger picture and also the insurance industry.
Yeah. Well, the insurance industry in general seems like it's been, I don't want to say a mess, but it's just been so many changes to it over the past few years, right? It just seems like there's payout after payout after payout with storms and different things going on across the country. These insurance companies must be hurting. And then you have a flood event like this, and it's just like people are reeling right now.
Throw on top of that inflation from the last 3 or 4 years. Probably,
the cost to rebuild
has gone up significantly, and labor shortages also have made the time that it takes to rebuild something far longer. Everything gets more expensive, and then claims have become more frequent, affecting more people. Mm-hmm. So you throw all those factors together, and insurance companies have been losing money, which is not par for the course historically.
Yeah, absolutely not. Beds, what's the number you used to quote as the standard homeowners insurance policy rate, and how has that changed?
$600 to $800.
Yeah, but now I charge higher than that. But Beds, what did you used to do, Chris?
It's funny you say that number, Jeff. Usually I was in the $550 to $750 range.
Exactly.
I'd creep the listing. I'd kind of analyze some of the things that I think I know, and I'd throw that range.
Yep, that used to be definitely the industry standard. I'd say these days we're looking more in like the 800 to 1200 range.
I do 1200. I do 1200.
If you're telling folks in single family homes to expect 1200, you nailed it, because it'll often be a little under that depending on where they live. Also, like what's the fire protection, how rural is it, etc. But that's a safe number generally, Randy. That's a good thinking.
But yeah, it's a big change from what we had done in the past. And I think you told me a little bit not too long ago just how people's premiums are renewing at the higher rates at renewal, like without any claims or without any changes to their personal situation. Like, people that maybe bought a home a few years ago and it was 600, 700, 800, they'll get their renewal, not even realize it. And it's $1,000, $1,200 with, again, that's what people can expect now, right?
It's often folded into the mortgage. So we'll get, usually they'll find out when their mortgage payment goes up. And it's been significant with a lot of companies across the board trying to keep pace with those claims that we were just talking about. And there is absolutely a lot of sticker shock at renewal when people find out, whether it's their auto and they get the paperwork, or it's their home and it's escrowed and they see their mortgage payment jump up to $20, $30 a month. And it's tough because insurance is an intangible product, and people, no one really enjoys paying for it. You can't see it, you can't touch it. And then for the rate to go up so significantly, there's been a ton of volatility in the industry, customer movement, company to company to company, than there has been in years past, like big shakeup.
Yeah. When you say that they don't know until their mortgage payment goes up, we're the people they contact first. I feel like, Chris, does that happen for you all the time? People are reaching out to you about, hey, my payment's gone up, and taxes also tend to be rising right now. But between the two, a lot of people's payments are going up, and it's
everybody,
tough conversations for us to have with them as well.
Yep.
Yeah. Jeff, I got a random question because we've been dealing with a higher interest rate environment. So a lot of our conversations over the last, 12 to 18 months have been sort of negative ones. And now we're starting to, I hope that we're at the tail end of the negativism of interest rates being higher, and my conversations tend to be more positive, okay, compared to what they were. What do you see? How does it look for you? What's your outlook? Are you in the middle of this? Are you further away from it than you want to be? What are you seeing? When does this get better?
I've been told by the guys who are much smarter than me that do the high level math that we should hopefully see a flattening or at least a sort of subsiding of all of the crazy rate increases in insurance in the next couple of years, in 2 years. I'm not sure how they arrived at that, but that's what I've been told. Again, they're much smarter than I am.
It reminds me of the experts that we listen to that tell us that rates were going to be better by last summer and then end of last year, and then here we are. So those things tend to move around a little bit, but it is nice to hear that.
It'll stabilize at some point. It all follows the economy basically. It can't continue to rise because people have to be able to afford insurance, because insurance is the basis off of which so many things run. Like your industry, you guys have to have insurance on a home if you're going to put a loan on it. The federal and the state governments require auto insurance in order to register cars. So at some point, it can't possibly become prohibitively expensive, or else something is broken irrevocably.
Yeah. Too much hinges on the housing market,
right?
Yeah, for things to just turn into $5,000 a year homeowners insurance policies, it'll cripple the market. So there's got to be a limit to what it can do.
Yeah. Although that is what people are paying in Florida currently,
which is insane. And a lot of companies are moving out of Florida, right? Or California or other states.
Exactly.
Yeah. I've got a buddy that's a commercial underwriter for Hanover, and he's talked a lot about the turn time for just guys that fix things, how elongated that process is, and with the supply costs and everything. It's just, that is such a big chunk of why their increases are happening on the commercial side. And I would guess, I know we're sort of reiterating it, but can you speak a little bit on that? Like the construction side of things and how that really affected premiums?
Oh, absolutely. I mean, look at the cost of how much did a 2x4 go up a few years ago? It was it was almost double the price that it had been, or something like that. So no one was anticipating that. If they had known, insurance companies would have ticked rates up in the years preceding it.
Yeah.
But it caught everybody with their pants down, and because of those increased construction costs, that's a huge part of it. Claims were costing more than anybody could have anticipated. So the construction side of it, affects us hugely, Chris. It's the reason why your homeowner's rate is probably going up.
Yeah.
Yeah.
So yes, the cost of repairing things or new construction, all that stuff is higher, but a lot of these insurance policies have baked in limits anyways. So it's
well, not if you have a good agent, basically. Yeah. So
I set you up. This is the alley-oop.
Every home insurance policy does have a limit, right? It'll say your home is insured for, say, call it $400,000. Yeah. That's the rebuild cost. Because of things like inflation, factors that we can't foresee, a good agent is going to stick at least one endorsement on there that bumps that up quite a bit if necessary. So, I know some companies do a 20% extended endorsement. So if the agent is good, they tack that on there. So it may be insured for $400,000, but we hit a period of high inflation with 20%. You can actually get up to $500,000 to rebuild your house. They're not going to cut you a check for $500, but if it takes $475 or something, they'll go up to that limit. So a good agent is taking care of their clients and making sure there is extension of coverage above the limit on the policy. Mm-hmm. Yours is actually infinite, Randy, because you're with Farmers Insurance. But because of that, it's a rock and a hard place, right? Because if you're taking really good care of your client, you're also probably costing the insurance company more in a claim.
Yeah.
Can I say all it takes is for Jeff to talk about insurance for Randy to have a really amazing smile. Do you see that thing right
I
now?
usually keep that mouth shut. I like to hide my teeth.
What if you have valuables, Jeff? So outside of this construction stuff, let's say you're a collector, you got sports stuff, cards, just a ridiculous amount of valuables.
Yeah.
How does it look on an insurance
All of that stuff, collectibles, firearms, jewelry, fine art, all of those items have a limit on a standard homeowner's policy. Most companies, it's going to vary between $1,000 and $5,000 per item, usually on the lower end of that. So if you own items that are above that, you can schedule them. They call it scheduling. It's a special endorsement on your homeowner's policy. It takes those limits away and it sets those valuables aside with their own separate coverage, usually which will have, a $0 deductible or $1,000 deductible, but has no limit on the value of the items. If they're expensive enough, you might have to get a separate policy outside of your standard homeowners. Mm-hmm. Usually your typical, your farmers, your State Farm, your Allstate, they're not going to insure your $500,000 wine collection or something on your homeowner's policy. But there are companies that sell specific policies for very big ticket items.
That is a good reminder. And I'm glad you asked that, because I think back to like my wife's a ring. I bet you it's probably a common one for people. Not that
That's
it's on
the most common one,
extreme high end, but it is a thing that fit a little bit outside of that box, and we did ultimately schedule it. And I think of some of the collectibles that you have, Chris, maybe that sort of thing is worth scheduling. So good to remind people that.
Yep.
I had a question about flood insurance because we had a good conversation about it not that long ago. What's the misconception about flood insurance and how it works for people? Because I was surprised. I should say I was surprised by how little it covers for people that even have it to begin with. And there's a lot of people that just, if you don't have it, you're just out of luck completely based on your homeowner's insurance policy.
There are a lot of misconceptions about flood insurance, Randy, and some of them are, dangerous, as we've seen in the last month. One misconception is that it is a formality that you need to check a box to get a mortgage, right? Because if you're in a high-risk flood zone, as you guys know, to get a mortgage, you have to have flood insurance. That's the way most people have looked at it, including insurance agents, realtors, and consumers. For as long as I've been in the business. The problem is that some of the places that flooded that we saw in this last 6 weeks or whatever, they were not in high risk flood zones. And a huge misconception about flooding is that it is covered on your homeowner's insurance policy. It is not covered on your homeowner's insurance policy, whether it is, 4 feet of seawater coming in, or even if it's groundwater in a bad rainstorm. That is not covered on your homeowner's insurance policy. For the seawater, at least, you can get a separate flood insurance policy. But again, most people don't even look at that unless their mortgagee tells them, hey, you have to have this to close on this house.
100%. No one wants to spend that money because we're talking thousands of dollars.
Yeah.
And if someone's not telling you have to get it, and I would think most people aren't going to have, you have to be pretty forward thinking to get that insurance policy. Without someone telling you.
The problem, though, is that it can, as you were saying, it can be prohibitively expensive. I had a guy from Scarborough call me today who is not in a high-risk flood zone, but because of recent events, he wanted to know what would it cost to put flood insurance on his house. $7,100 a year, and it only provides $250,000 of coverage. That is the cap on the federal policy, and private companies have started getting into that market. But for some reason, so far, they only copy the template from the government's policy. So it has the same $250,000 cap, and it has to be 2 or more acres of water affecting 2 or more properties. So, and the coverage guidelines are very stringent also. Any contents that you have in your basement below grade, not covered. Somebody's generator, not covered. Yeah. Even if you have contents coverage, like it's very, very stripped down. It's honestly, it's not a great product, but it's the only thing we have. Yeah. And in a lot of cases, it's better than nothing, certainly.
It just makes me think like how screwed the people are from what happened a few weeks back here in Southern Maine. Like there's so many houses and so many videos and pictures that we saw online. And it's like most of those people are probably in really bad shape because of this.
Like that run Fortune's Rocks.
Yeah, that's in Biddeford. Oh my God. Driving by that, it's a mess. It's a mess.
What's going to happen with that?
Camp Alice and Saco. Yeah, those, I don't know what happens. Yeah.
Randy, you know about this property. Jeff, my wife's family has a property down here in Saco. I've never seen the ocean that high up on the dunes because he has a waterfront property. And he's got like this stretch of 30 feet prior to his home. It used to be a bowl. The amount of sand that came up from the beach over the dunes and filled that level will blow your mind.
Yeah.
Like, I don't know where I'm going with this other than I feel for the people that have got flood issues. Because what do you do?
It's as I said, it's been a rough month. And unfortunately, those claims are not easy to handle either. You've got FEMA involved with some of them. You've got government entities. It's about as bureaucratic as you can imagine. The time that it's taking on these claims is, there's a lot more back and forth than there is on like, a standard fire in your home or you get in a car accident or something.
Yeah.
And then you have that back and forth, and then you hope that you can get a contractor to do the work.
Yeah. There's that too. Yeah, and there's extra steps too of like in some cases they need engineers to come out on top of the claims adjusters to verify that it's a total loss, and there are so many moving parts. They had to fly in. They flew in hundreds of claims adjusters last month from all over the country who are in southern Maine.
Wow.
Yeah, it really is a crazy situation. I appreciate you like shedding some light on it because I think it is something people need to hear about, and we need to spread the word on it in our industry, especially. So hoping our realtor partners or anyone listening hears and honestly reaches out to you to talk more about. Last question I had for you. What's the importance of working with a local insurance agent? Why is that so important? We see a lot of people that don't, and we try to steer them the other direction. But can you tell me why it's so important?
I will give you the easiest example because we were just talking about it. If you don't have a local insurance agent or somebody on your side, you're going to be dealing with the 1-800 number of the National Flood Insurance Program and FEMA yourself.
Yeah.
Gross.
That in and of itself is worth a few extra bucks a month to have a local agent. Let me tell you, because I have spent hours on these flood claims advocating for my clients, lighting a fire under people, claims adjusters and desk adjusters, internal examiners, and coordinating engineers. And a good local agent is willing to go above and beyond for their clientele because, hey, it's human nature. That's how we make our money. Like if my clients don't renew their insurance, I don't get paid. So, at the end of the day, if you just want to boil it down to the very most basic human nature, you should have a local agent because that person is incentivized to help you. Unlike the person on the other end of the phone on a 1-800 number who really couldn't care less.
Not that different than our industry to some, like certain similarities. We have boots on the ground in the communities that we work in. It makes sense for us to work hard to keep the referral partners that send us the business happy, to maintain our reputation in the market, all that stuff. So I can totally relate to that. And I appreciate the work that you do for our customers. And, you have a great team. So I appreciate you coming on to kind of talk about the industry a little bit, spread the word on that stuff. So
my pleasure.
All right. That was some pretty good info from Jeff. What do you think?
Yeah. Especially given the climate right now, it's always good to hear from an insurance agent. And obviously we hope you guys enjoyed it. I know I did.
Yeah. A lot of useful information for people listening. Jeff's a great resource and definitely knows what he's talking about. And it's just such a changing environment, and insurance is such an integral part to our business. It's nice to have these key relationships that we have in the area of people that we can refer our clients to. Jeff's one of them, and I know we had a bunch of other different people too, but Jeff was great. So appreciate his time.
I don't know about the Raiders fan part, but we could talk about that another time.
Yeah, we didn't that was off camera. Poor Raiders fan, it's tough when the Chiefs are so good. Anything else coming up before we wrap up? We'll do this again next month, but anything else going on?
That's it, guys. Hopefully the purchase market heats up. I feel like things are starting to kick up a little bit more. I'm looking forward to the sun coming out more regularly. Golf's right around the corner. Boat season, all of that stuff. So let's start being positive.
Yeah, it's going to be good. So, all right, bud. Nice job. We'll talk soon, all right?
All right, we'll see you.
All right, see you.